Hi, good morning, everyone. Welcome to our weekly morning webinar. Today, we'll give a brief overview on the latest Del Monte results, followed by a more in-depth overview of the commercial property sector, and after that, we'll end the webinar with an overview of 800 Super, which we have recently initiated coverage. Right. First is on the first quarter result of Del Monte Pacific. This is the first fiscal quarter in the new fiscal year. Firstly, revenue was reported at about 445 million US dollars, with the bulk of it coming from the US Del Monte Foods. And based on the quarterly revenue that accounts for about 20% of our full year revenue forecast. However, I do want to iterate that this is still in line of meeting our forecast as basically it is still in line with seasonality trend, and we do expect more sales will be generated in the festive season ahead, mainly the Christmas, Thanksgiving, as well as Easter's. So for this period, it just happened to be the weakest sales seasonally. However, for the quarter, Del Monte reported a net loss of close to 22 million. That's mainly due to non-recurring expenses relating to the acquisition of US Del Monte Foods. Adjusting for the non-recurring expenses, however, the net loss is still roughly about 2.4 million. And that was mainly due to the impact of a higher cost of goods sales due to the upward revaluation of inventory when Del Monte Pacific acquired US Del Monte Foods. The upward revaluation of inventory was also partly due to the change in accounting standard, as US companies typically report under the US GAAP accounting standard. So hence, due to from the acquisition, this resulted in a higher revaluation of inventory, and that flows down to the higher cost of goods sold. So we do expect that the current fiscal year will still have the impact of higher cost of goods expenses in the following quarters, as the US Del Monte Foods will have to clear up their inventories for following the acquisition. On the growth strategy, the Del Monte has undertaken several measures since then to regain market shares in the US, as well as to targeting to boost sales to the historic level of over 1.8 billion, which was before the acquisition by KKR. So these measures include lowering of product pricing to the competitive levels. Previously, US Del Monte products command about 70% premium in pricing after KKR implemented some changes. So hence they're gonna bring that back down to the 40% premium in some of the products generally. So hopefully this will help to regain some of the market shares. This premium in pricing is compared to the private label products. Also, another measure is reverting back to the classic product label, which was regarded as one of the contributing factor to the sales decline under KKR's ownership for the US Del Monte Foods. And third measure is a step up in trade promotional campaigns, and that will help to reverse the cutback in trade promotion spending when the US entity was still under KKR. Other growth strategies will include bringing products that were successful in Asia to target the ethnic consumers in the US, as well as cost savings from outsourcing of the Del Monte Foods backend functions to the Philippines, and that will help to realize significant cost savings in the operational expense, as well as a migration to SAP system in February 2015, which will boost productivity in the backend systems. Also, the Del Monte Pacific will carry on to focus on continued growth in Asia Pacific region and boosting the branded sales segment, mainly for the Del Monte and the S&W products. However, there are still some risks remaining, which is basically in the current fiscal year, we still have impact from the inventory revaluation of Del Monte Foods, as well as the pending preference shares issuance and rights offering, which will likely we should have some dilution effects on the shares, as well as due to the preference dividends. Well, this will help to reduce some of the income that may be attributable to shareholders. However, in view of the better results ahead, as well as the excellent growth potentials that Del Monte Pacific offers, we are still maintaining accumulate rating with a target price of 60.5 cents, right? And that's based on PE of the average peers, based on FY16 forecast EPS. Right. Next, I will hand over to my colleague.
Hello, hello everyone. Sorry for the technical issue earlier on. Can you hear me now? Okay, we shall resume our webinar. Today, I will give a brief overview of the Singapore commercial sector outlook, which will include the office, retail, and hospitality. First, let's take a look at the office sector. For the first half of this year, office sector is the best performing subsector in the real estate industry. The listing activities and the inquiries remains healthy with particular focus around the CBD area. The rental rates for the first half has up about 5.6% in the central region, with stronger growth in the prime A office space of about 8.7% growth. The vacancy rate remains low at about 5% for the grade A office. The overall will be at higher, about 9.64%. For the first half, for the second quarter, the net positive absorption rate actually went up to 237,000 square feet, up from 65,000 square feet in the first quarter of this year. So the demand is mainly driven by flight to quality trend and the expansion or setting up of regional office in Singapore for ASEAN with competitive tax structure, stable political and transparent legal environment. However, there have been a small change in the listing trend. Traditionally, it is dominated by the financial house listing big spaces in about 2 to 3 years ago in 2011 and 2012. The transaction list usually is about more than 100K per square feet. However, now majority of the lists are closed at smaller deals at about 10 to 30K, dominated mainly by the energy, commodities, insurance, e-commerce, FMCG, and trading sectors. For the office investment sales activities, office still actually consists quite a huge portion. It accounts for 1.846 billion, about 40.7% of the total investment sales for the second quarter. Main sales close includes the sales of the Equity Plaza, Prudential Tower, and Cecil House. For the second half of 2014 GLS program, one commercial site at Paya Lebar is listed on the confirmed list, and 2 office sites in Beach Road and Marina View are on the reserves list. So basically, let's take a look at the office supply. The CTV office supply, as you can see from the graph, it remained tight for the next 2 years, 2014 and 2015. However, with only the Capital Green and South Bridge Tower for completion at end of 2014. And 2016 and 15, you can see there's actually nothing to be completed for the in the CBD area. Yeah. However, the concern is the pre-commitment take-up rate for the new completion is lower, as most large global banking occupants are focusing on cost reduction, so they are actually no longer the main takers in the CBD area. Per what we understand, for Capital Green and South Bridge Tower, the pre-commitment rates is about 23% and 20% respectively. And the next concern is, as I mentioned earlier, the upcoming huge CBD supply in 2016 and 17 accordingly. The Singapore GDP growth forecast is also muted at about only 2 to 4% for this year. According to our studies, there is a dip in the business confidence in the third quarter this year, mainly due to the unclear global recovery. So companies may hold back on expansion plan, which will also may affect the demand for the office supply. So, however, just to summarize, the overall, we still have a positive outlook for the office sector, with slowing office rental expansion rate for the second half of this year on the back of tight office supply in 2015 and the current low vacancy rate and the take-up rate of by the small space occupants. Demand for Grade A office in the prime location still remains strong with possible dip in the Grade B or older office buildings. Moving on, let's take a look at the retail sector. Retail sales index X the motor vehicles slide to 110.4 for June. This is a fall of about 1.2% quarter to quarter and a fall of 2.1% year on year on a seasonal adjusted basis. The discretionary consumer spending in June for watches and jewelry and the recreational goods are down 7 and 10% year on year, mainly due to the decline in the tourists from China. Rental growth is flat with about only 0.4% quarter to quarter, with tenant resistant to rent increase and with occupancy rate at 98.2% for second quarter of the year. 3 new malls opened in second quarter: Orchard Gateway, Kallang Wave, and One Raffles Place. These with good accessibility. These 3 locations with good accessibility to public transport still managed to open with a healthy occupancy rate of about 80 to 100%. Shredded retail sales, however, has been subdued. The average capital value at Prime Orchard and Prime Suburban area stay constant at about 7,000 and 4,005 per square feet respectively. The most recent major transaction is the Fraser Commercial Trust acquiring Chinese City Point for about 300 million. Our concern for the retail sector is the strong Sing dollar and the lack of suitable retail space delay the entry and expansion of some international retailers. And also second, the rising operating business costs and the labor shortage. Third is the huge upcoming supply of retail space in 2014 and fourth is the fall in the visitor arrival, especially from the China side. So overall, we still remain neutral. We have a neutral outlook for retail sector in the second half of the year. Strong fundamentals, low employment rate, and moderating inflation imply strong purchasing power to support the demand for the new supply in near term. So the demand is likely to be driven by F&B, fashion, and the service trade. Rents in Orchard area will likely remain robust with limited new supply from now till 2018. Listing activities in the secondary market and regional centers are to remain active, though it will be a while for the huge influx of the retail space in 2014 to be absorbed. Okay, sorry. Last, we'll actually take a look at the hospitality sector. For hospitality sector, it actually underperformed for the first quarter of this year. The tourist arrival actually down 8.4% to 1.18 million for June, and this is the fourth consecutive month of year-on-year decline since March. The total tourist arrival down 2.8% to 7.5 million as compared to 7.7 million in last year. The decline mainly is attributed to the drop of about 30% 30% drop in the China visitor arrival for the first half of this year. There are a few reasons mainly contributed to this decline. Number one is the new China tourism law, which was implemented last year in 2013. If you To give a little bit of background, in the past, for the Chinese package to the Chinese package overseas usually are priced very cheap, with most of the itinerary in the travel going for shopping, where the guides will actually earn the commission accordingly. However, from last year, there's actually has been a change in the law saying that you are not supposed to plan so many shopping trips to actually have the tourists buying so many shopping to earn the commission accordingly. So the package now is actually priced more expensive, and this has actually deter the Chinese from traveling over to our region already. This is number one. Second is the flight in the MH370 incident and the political unrest in Thailand too. So for China, it actually accounted about 11.6% of the total visitor arrival, second after the Indonesia, as seen in the graph here. Excluding China, the visitor arrival from other markets actually grew about 2.3%, a small growth over the six months period. In order to counter this decline in the Chinese visitor, the Singapore Tourism Board has recently launched about 1 million marketing campaign to attract Chinese visitors and promote the city-state as a standalone tourist destination. As in the past, usually they would travel to around the region, include Malaysia and Thailand, with Singapore as one of the stopover point. So tourist recipient by the Singapore Tourism Board is forecasted to be about 23.8 to 24.6 billion. The tourist recipient for the first quarter actually is actually about 6 billion, which is still in line with what they have forecasted. However, to reach the Singapore Tourist Board target of 16.3 to 16.8 million visitor arrivals in 2014, we will need about 12 to 19% year-on-year in growth in the arrival for the second half of this year, which we feel that it actually poses a downside risk to the target unless there is a substantial spike in the visitor arrivals in the second half of this year. Else, we feel that it's likely to be a miss in this target. The average hotel occupancy rate actually was down to marginally to about 84.7% the first half of this year. Average room rate was up while RevPAR was down for the first half. The occupancy for the luxury and the upscale hotels still remains strong. However, the occupancy was down for the mid-tier and the economy hotels for the first half of this year. We believe this is mainly most of the Chinese tourists actually stay around in the mid-tier hotels, and this has caused the fall in the occupancy rate. RevPAR for luxury and upscale and economy posted slight positive growth, but the mid-tier faced most pressure with a decline of negative 4.1%. This is just a overview of what is the performance of the average room rate, RevPAR, and the upcoming hotel supply. As you can see, there's pretty strong supply within the next 2 years or so. Hotel pipelines from now till 2018 is expected to be about 11K, with majority in 2015 to 2016 as shown in the previous graph. In the 2014 GLS program, there has been no new hotel site introduced. Some upcoming events and attractions which we believe might draw more visitors to Singapore includes the stop huts for sporting and entertainment events and the National Art Gallery. Our view for the second half of this year is neutral in hospitality. Demand is expected to rise with the opening of the new attraction and the government effort to strengthen Singapore's position as Asia's top MICE destination. We expect an increase in the tourist arrival on a year-on-year basis for this year, but as mentioned earlier, will be below the Singapore Tourist Board initial expectation. The upcoming supply pipeline will limit the room rate upside. Hello. Luxury and upscale hotels or hotels with strong corporate customer base should still remain resilient, which will be less affected by the decline in the Chinese tourists. Overall, prime office, retail, and hospitality sector are to remain resilient, though for now we see lack of bull run catalysts in the near term. So we suggest to be selective, prefer counter with a geographical diversified portfolio, low gearing and fixed rate debts to counter potential interest rate increase, and focus on counter with organic growth via AEIs or investment development acquisition projects, and with a strong recurring income. For counters that are under my coverage that consists of Singapore commercial sector will be Amara. We feel that the upcoming Amara Bangkok and Amara Shanghai will double the revenue for the hospitality by financial year 2016 once the hotel is completed. Resilient performance for 100am and Amara Singapore underpinned by the strong corporate customer base will support the earnings accordingly. So for our rating for Amara, we maintain buy at target price 70 cents. Next is Hobby. Hobby has a geographical diversified portfolio and posts strong recurring income. Main catalyst will be the development income from the overseas residential project in the financial year 2015 and 2016. Our rating is accumulate at target price 2.50. Last is OUE. OUE has visible earnings pipeline with AEI activities like the OUE downtown and the service apartment expected to be completed in 2016, extension of the Crown Plaza and the JV project in in Korea for the hotel development. And also we like OUE for their diversified portfolio of assets in the prime location. Our rating is to accumulate with a target price of 2.61. With that, we shall move on to 800 Super Holdings by my colleague Richard. Thanks.
Hi, good morning. This is Richard. I'm going to present on 800 Super. We had a report 2 weeks ago. I'll take you through the agenda for the presentation. Start with the company snapshot and then followed by business model. Introduce you to the industry trends and operating landscape for the company, and then the investment merits for 800 Super as well as the re-rating catalysts, and lastly the investment thesis, investment actions, insider transaction, and the conclusion. This is the company snapshot. Last close on Friday was 47 cents, and we have a target price of 67 cents and a trading buy rating. Now talk to you about the business model for 800 Super. They have 3 key business segments. The first is the waste management and recycling. So they are one of 4 public waste collectors as appointed by NEA, and they have the contract for waste collection in the Ang Mo Kio Toa Payoh sector. This contract was recently renewed and started again on January this year, and the contract is for 7 years and 9 months. Apart from the public waste collection service, they also do waste collection for private, institutional, and industrial clients. Moving on to their next business segment is the cleaning and conservancy. They're also one of 5 contractors for street cleaning in Singapore, and again the street cleaning contracts are managed by NEA, tendered out by NEA. So apart from the public cleaning, they also have residential, commercial, industrial, and institutional clients. And the last business segment is their horticultural services. This includes grass cutting, tree pruning, landscape planning, and maintenance services. So they are also one of the contractors for N parks, and they also do schools, residential, commercial, and institutional clients. These 3 charts show the data from MEWR. So the first one on top shows that total waste collected in Singapore has been growing. Last 10 years it grew at 5%. And then this second chart shows here that in 2004 the amount of waste being recycled has more than the waste that's being incinerated. This shows that recycling is gaining traction, and over the last 10 years recycled waste has grown by about 8% compared to the 2% for incinerated waste. And this last chart shows that recycled waste has grown from 47% to 61% here in 2013. So the operating landscape of their key businesses. For waste collection and recycling, they are the service provider in Ang Mo Kio and Toa Payoh sector, which is here. And the industry has 4 players competing for the 9 sectors. So the contracts given out by NEA typically last for 7 years, and there are other contracts for their other clients like shopping malls and town council. They last for about 2 to 3 years. As with their cleaning and conservancy business, a bulk of their revenue from this comes from their integrated public cleaning service, which is tendered by NEA, and there are also 5 players in this sphere. And the cleaning industry for institutional clients is estimated to have about 1,000 service providers. Investment merits for 800 Super is that they have 2 core business segments of waste management and public cleaning, and each of these business segments operate in an oligopoly with high barriers to entries. The high barriers to entries come about because of the nature of the contracts, where they will have to tender from it and tender for the contracts from NEA. 800 Super also has a distinct advantage of already having 2 recycling facilities, and they have a 3rd in the pipeline. This will capitalize on the trend of the shift towards recycling. And it's a recession-proof business model providing non-cyclical essential services. The price for 800 Super has been undervalued by the market due to information inefficiency and unglamorous business that is not well understood. Lastly, with the new contracts kicking in, we see that cash is building up for 800 Super, and this raises the possibility of higher dividends being declared. With the new contracts, actually 800 Super has effectively increased its market share for the public cleaning business. Previously, they had the Northeast region, and now they have the Northwest and Southwest regions. The partial contribution of their new contracts in FY14 resulted in strong growth, and we are expecting to see a bigger jump in EPS for FY15 when the full impact is consolidated. And we explained that the price of 800 Super has been undervalued because of absence of analyst coverage. So this is a timeline here showing the timeline and when the existing contracts are dropping out, and this is when the new contracts are kicking in. So the old contracts, the transition phase is between these two reporting periods, the second half of FY14 and the first half of FY15. This table here shows the information on the new contracts that will be coming in, and these are the contracts that will be dropping out. So we rationalize that based on their, we rationalize that 8 times PE is a bargain price to pay for a profitable recession-proof business model with core business revenue visibility for the next 6 to 7 years and a track record of growth. So we think that 8 times is conservative, and it could be worth more than 8 times in fact. So we have a trading buy rating on 800 Super, and the target price is 67 cents. This is the forecasted EPS for FY15. And you can see that based on forward PE, 800 Super is still undervalued relative to peer. Insider transaction, 2 Mondays ago, their COO had purchased 100,000 shares, 50,000 at 40 cents and another 50,000 at 41 cents. So he has increased his stake from 400,000 to 500,000 shares, and his direct interest is now 0.28% of the total ordinary shares. What we believe is that this sends a signal to the market that even at 40 and 41 cents, there's still value in the share price. So conclusion. Business model is profitable, recession-proof, and there's revenue visibility, and they have a track record of growth. So when we benchmark against their 7 times PE multiple, which is the length of their biggest contract, we rationalize that 8 times is a conservative minimum that it deserves. And based on our conservative back-of-the-envelope EPS calculation, FY15 would have a minimum of 7.46 cents EPS, but that is back of the envelope without taking into account the addition of the new contract coming in. So that is a negative 11% deviation from our estimated 8.38, which would be somewhere here. Negative 11 will be around here. So this table here is a scenario analysis where we have different EPS variation from our estimate of 8.38 cents and the variation in P multiple as well around our 8 times estimate. So this 67 cents here is our target price, and you can see that this corner would represent a conservative estimate, while this corner here is a more aggressive estimate. So even if you are if you are more conservative and you believe that is PE of 8 times, you will still get a 60.5 cents target here, which is still about 20% from today's price. Okay, we have come to the end of the webinar, and we'll take your questions now. Okay, there's a question on what is the ratio of Singapore employees versus foreign workers hired by 800 Super. This information was not disclosed by the management, but we did ask about how is their impact on their, how would a foreign worker levy impact them. The response that was given by management is that actually about majority of their workforce is actually the auntie uncle type and not the foreign workers.
Hi, I believe there's a question regarding Lentrovision at the start of the webinar. However, the question unfortunately has been lost due to the interruption. So appreciate if you can repost the questions on Lentrovision. Thanks.
Hi, there's actually a question on the comment on the business but industrial sector. Yes, from what I understand, for the industrial sector in Singapore at the moment, because for the next 2 years, there's likely to also be a huge supply upcoming in this. This is just a general. I have not gone into details for that, but from what I understand, there will be a like incoming incoming supply for the in the industrial sector, and likely the price for the growth outlook for the industrial sector is likely going to be flat with maybe like 1 or 2% growth, very minimal marginal growth, at least in the coming 1 to 2 years or so. And another say ask is any REITs counter Philip is bullish on. Sorry, but for now, actually I don't cover any rates, but for what I see is for what I see is actually I feel that for rates, two well maybe you can take a look at as the OUE hospitality rates and also the CDL hospitality rates. From for the OUE hospitality rates, the although that for now the hospitality we are actually neutral on it, but because for the location for the OUE asset, H Trust asset is in Orchard, which is very prime, and the supply over there is still going to be very limited. That's why we are still positive on this. Thanks.
There's a question on who is a major shareholder for 800 Super. The major shareholder are the two brothers.
I have an earlier question. Benjamin here speaking, the financial analyst. I have an earlier question on the Hong Kong Shanghai exchange and when is it going to happen. So far from the time when there be no, currently, I think since 13 September there was a second round of market testing. Then following that, the tentative launch date is still around the mid of October, around 13 October from the last date that we got. In terms of the sell down wise, from what we saw, I think it's more likely attributed to the China's macro outlook rather than on the Hong Kong Shanghai exchange news. So if we track back to the China macro news, from what we see, I think today, the China finance minister actually indicated that he will not make much major policy changes from the government, right, in response to falling foreign direct investments and home prices. So this somewhat dampens the market anticipation of any economic stimulus to the China market, right? In terms of anything else for the Hong Kong Shanghai exchange, I think there are some arrangements in place, such as daily quotas as well as trading restrictions that we have. In terms of all the details wise, I guess we can contact your trading rep to ask him more about it.
Hello. There's actually a question asked on any updates on Cinema Lens. Latest news that we got on Cinema Lens is actually the acquisition of another UK properties, the Soho properties, in August. As for this, because now this counter is undergoing a change of analyst, which is me, but I'm still studying on it. So at the moment, I have not reviewed on the prices yet, but our stand is still remains our rating still remains on the price with the previous target price of 0.97 cents. Thanks.
There's a follow-up question on 800 Super about their manpower. Sweeping roads and clearing rubbish isn't their only business. They also do cleaning of offices, and they also clean the airport terminals. So not all of their manpower is deployed in on the streets.
Hi, someone actually asked for the example of the properties for Hobie. Okay, Hobie, the main flagship asset for Hobie will be the Metropolis, which is located at the, I think, Buena Vista area. And also, they have two UK office property, the Rose Court and the St. Martin's. Thanks.
There's a question on inflation indexing for 800 Super's contracts with NEA. Yes, there is a inflation indexing, but it doesn't occur every year.
Hi, this is Colin here. There are several questions on land vision, which I will try to address each one of them. Firstly, it's okay. Firstly, on the sales and on the abilities to collect the sales, right? In fact, if you look at due to the some of the historical quarters, in fact, this has actually been gradually improving in regards to the ability to collect the sales. Due to the nature of their business, whereby they are mainly doing installation works, cabling works for various projects, and some of these projects have varying term, in fact, rather lengths of the project, right? So it really did is not expected to be consistent in collecting, for them to collect the revenue on a consistent basis, because this is due to various natures of the projects and what they have on hand, right? So overall, but I do not think that there's a very big risk in that. Also on the financial risk, they are actually having a very healthy net cash balance. As to what they're gonna do with the cash is they may be looking into expanding the business into the region inland in the countries which they have already have a presence in. One example is the Myanmar, which they have recently penetrated in. So this is one possible use of what they'll probably do with the cash, right? And okay, another question is mainly on the rights issue, which they did sometime in 2012. The rights issue was, firstly, it was following the share consolidation of mainly 100 shares to one, and due to that, there'll be some shareholders that they'll be left with these uneven lots. So hence the right issue was actually held to mitigate this impact of this uneven lots for some of the shareholders, and the proceeds they actually have given back through special dividends, right? If you look at the fiscal year 2012, they actually given quite a huge, a good amount of special dividends rewarding shareholders.
Hello. Regarding on the Hobie properties that I mentioned, the three major properties that they are owning right now, these are offices and they are for lease, not for sale. So recurring income come from the rental of the office. Thanks.
Hi. Sorry, back to the Lentro vision on relating to third quarter on their inventory turnover. Mainly, as I've mentioned, the rights issue was the main rationale of why they do the rights issue was mainly to mitigate the uneven lots for some of the shareholders, and they have already returned the proceeds through special dividends. So hence, we don't think that was really the rights issue was not really meant to buy up supplies, as they do have a very strong hold of the cables. I believe there's also an earlier question on pricing power of Lentrovision. I assume it's with regards to pricing power which they have to offering to customers. Mainly for Lentrovision, one of these competitive advantage is that it has the expertise of and also the Lentro Alliance Global Partners, which allows them to court major global MNCs and having one common vendor to help support their global infrastructure rollout. So this is one of the competitive advantage, and hence which we have noted in our reports, many of their major customers include some of the financial banks, US Fortune 100. So hence they are, I believe they do have some pricing power in that due to the resources which other competitors are not able to provide, such as supporting the global infrastructure rollout, as well as a huge amount of the cables which they have in their inventories. So mainly for they do have pricing power over projects which requires high complexities and huge amount of cables involved. So this is one of Lentro Vision's core strengths in the cabling industry.
Hi, Benjamin here. I'll take a couple of questions. I'll address those as relating to the Hong Kong and Shanghai Connect Exchange first. Okay. First of all, yeah, there was a question earlier on whether our research team can include Hong Kong shares, right? For that, can refer you to accessing our regional node. From there, usually almost on a daily basis, there are quite a good number of research reports from our Hong Kong and China team, right, on course on both Hong Kong counters as well as China counters, right? And then I have a question also on whether we can trade China stocks when the Shanghai Hong Kong Connects becomes available. Right, for that, I think for the trading wise, from what I gathered was that you can only do it through voice and email booking, and there's a day limit order as well. But for the exact details on that, I'll refer you to contact your trading rep as well for any more minute details before this is ironed out fully, right? And then I have an earlier question on the oil and gas sector in general and any counters to recommend. Currently, under our universe, we cover the rig builders, Keppel and Sembcorp, and then we also cover Ezion and Ezra as well. But just take note that for all these four counters, we are still undergoing a transition. Right, in terms of the general, the calls wise, Ezion so far is still the only one that we have an positive call on. The rest is neutral to reduce call. Right, for the oil and gas sector outlook, first of all, let's look at the deep water segment outlook. For that portion, generally it's a bit it's quite negative on that front, right? At least for the next 1 to 1.5 years, as a lot of the oil majors have actually committed to less capex for this year going forward in terms of E&P, which is exploration and production spending that they're going to. So for the deep water segment, we are seeing quite a bit of pressure on that from both less orders coming through for, let's say, semi-subs as well as drill ships across the globe, right? And for the shallow water portion, it's still quite, at the current moment, it's still quite robust. We are still seeing Keppel winning an order. Last week, they just took a 227 mil order for a B class jackup, right, which is a repeat order. So shallow water wise, still seeing quite robust demand for jackups, right? But going for the 2015, there'll be quite a large influx of jackups that are coming in from China yachts as well as from the Singapore yachts as well, and a large proportion of these are still uncontracted. So we might be seeing some oversupply in terms of jackups for 2015, right? So for us, unfortunately, we do not cover any offshore support vessel counters, but in my opinion, this would be quite a good sector to look at, right? Considering that quite a few counters that have access to the Mexico market as well as the Brazil market, right, should see quite a bit of upside from increasing number of contracts for their offshore support vessels, especially for the AHTS and PSVs, right? So this is one sector of the offshore marine that we can consider looking at, right?
So someone actually asked where to read the Hong Kong reports. If you have a Poyens account, kindly you can go to the if you have a Poyens account, you can log in via Poyens 2.0. Go the tab research and then tap on the Hong Kong tabs. Then you can find the Hong Kong reports that we have posted there. Thanks.
Hi, there's a question on whether do we see Lantro as a potential takeover target given their unique market position and cash flow. We do believe that when we talk to the management, there was some interest from companies. Of course, there's no announcement as this is what management has shared, that there are potential companies that wants to look into Lantro Vision. However, it seems that the current management is not interested in selling the business as of yet, and they are still very much into wanting to continue to manage this cabling structured cabling business. So hence, meanwhile, we do not really see Lantro as a potential takeover, or at least in the near term.
This is Richard speaking again. I'm going to address some of the questions for 800 Super. First, what is the time frame? Time frame, as usual, is 1 year. We are banging on the FY15 results So that's 1 year from now. And I'm going to give explanation on the difference between buy and trading buy. For trading buy, we do not commit to ongoing coverage for the counter. So, but it's still equally the same as a buy, except that we're not committing to coverage subsequent to this.
Hi, there's a question on with regards to Del Monte. What's a good entry point, and whether should it be before or after the rights raising? On our view, we think that the Del Monte price has probably has rather bottom out as the right after the announcement of the acquisition, and also the reported loss. Now share price has kind of remained stagnant at the current level, and we do think that this there's only more upside to it. As to whether should then should be investing in the Monte share before the rights offering, the what I can share is that the advantage of going buying into the Monte share before the rights offering is that you will have be entitled to the rights offering, which will not typically may have a discount of roughly about 20% to the share price, right? So this is one benefit of going right before the rights offering. However, of course, the downside is that then you have to allocate even some funds to acquire the more shares from the rights offering. So this is whether to should be before or right after the rights offering. You do have to take note of this point, right?
Right, Benjamin here. The question on our view on Sembcorp Marine. Our last call on Sembcorp on Sam Marine was still reduced, right? Because in terms of near-term outlook wise, for both the rig builders, it's not too bright in terms of the order book outlook. I mean, although year-to-date order book is still pretty strong, but going forward, in terms of order wins, we might be seeing quite a bit of downward pressure, right? Because again, going to 2015, we are seeing quite a bit of oversupply coming in from both the jackup market as well as in terms of the deep water side, right? That's not enough in terms of the deep water side. Contractually wise, I would say most, based on the statistics, about 50% of them are still not contracted yet for new builds that are coming in, right? So that's why we're not too positive in terms of order wins going forward in the near term. Right, but long term wise, we are seeing that Sembcorp is committing quite a bit of capex for both their phase 2 of their integrated yard at Tuas, as well as constructing a new steel fabrication plant facility, right, so that they can do some integrated engineering, right? So they are committing quite a bit down the line for their future. So for the long term outlook wise, Sembcorp is committing quite a bit, but our call is still reduced, right? On top of that, there might be quite a bit of margin pressure going forward in the second half of this year due to them executing their drill ship delivery, right?
Hello, there's actually a question on can you talk about the Indonesia palm oil sector and any recommended share counter? For Indonesia palm oil currently, we feel that the price is still going to face some challenge, mainly from the huge supply of the oil seeds that's upcoming. And also the takeoff of the biodiesel B10 isn't as smooth as what they expected. But on the whole, we feel that now the price has more or less been is quite low as for now already. As for our coverage, we have Golden Agri and First Resources. For First Resources, we maintain a buy position, and for Golden Agri, you have a neutral position. Thanks. Okay, that's all we have for today. Thanks for tuning in. See you guys next week. Bye.